Every article about the buy, borrow, die starts the same way. This is the strategy that the ultra wealthy use to avoid taxes. You need to always be rich for this to work. This isn't realistic for the average investor. Welcome back to another episode of Almost Wealthy. I am John. I want to show you why every one of those articles is wrong. Not wrong about what the strategy is, wrong about who can use it. I started this strategy with $6,000, a $6,000 portfolio, a regular paycheck, a margin account on M1 Finance. Phase 1 and Phase 2 are already running. The phone bill and the internet bill are already off my paycheck, and I'm closing in on Phase 3. So today, I'm going to show you the version of the strategy that nobody talks about, not the billionaire version, the one you can actually start from where you are right now. I want to give thanks to 3 people who supported the show: Dave S., April B., and Mikey Marty M. Mike, thank you for the review that you sent. I want to share it. Truly helpful, and the content is ideal to follow. You also don't go Wolf of Wall Street crazy, and that's awesome. Thank you, and keep going. That's exactly what this channel is built to be. Every dollar donated goes straight into the Freedom of Time portfolio to help it grow. And with that donation, you get the buy, borrow, die bill stacking plan spreadsheet, the exact one I use to track every phase on this channel. If you want to grab the spreadsheet, the link is in the description. Thank you so much. I appreciate it from everyone for your support. Now let's get into it. Now let's get to the basics. What buy, borrow, die actually is. The name sounds complicated. It's not. Buy, borrow, die. 3 words, 3 steps. Step 1, you buy assets that grow and pay you income. Stock, ETF, real estate, things that go up in value over time. Step 2, instead of selling them to pay your bills, you borrow against them. You take a loan, the assets are your collateral. Borrowing is not a taxable event. Selling is. When you sell a stock for profit, you owe capital gains tax. When you borrow against it, you owe nothing to the IRS. You just have a loan. Step 3, when you actually die, your heirs inherit the assets at the current market value. The IRS calls this step-up basis. All the gains you built up over the lifetime get wiped clean. Your heirs don't pay tax on what the asset earned while you held them. So the full picture is build wealth, live off loans instead of selling, pay no capital gains tax, pass it on tax-free. That's why the ultra wealthy loves this. That's why it gets written about as some rich secret billionaire trick. But here's what the articles miss. The strategy doesn't start at the top. It starts at the bottom, and the bottom is a lot lower than $1 million. The articles aren't lying. They're just describing the wrong version. They're describing the end game, the version where you already won. Here's how they frame it. Let's say you have a $5 million stock portfolio. You want $200,000 a year to live on. Instead of selling and paying 20% capital gains tax, you borrow $200,000 against your portfolio. Your dividends may be $150,000 a year on that $5 million portfolio, which covers most of the interest. The rest comes from the portfolio growth. You never sell, you never pay taxes, the loan stacks, you die, your heirs inherit it, gains disappear. You need $5 million or more for the math to work cleanly at that level. People read it and think, okay, I'll start doing this in 30 years when I'm rich. That's the wrong takeaway because the math works at a much smaller scale. You just need to think about it differently. Now let's go back to my buy, borrow, die bill stacking spreadsheet. I built a 10-phase plan. The idea is 1 bill at a time. Each phase has a portfolio target. When the portfolio hits that target, 1 more bill moves off my paycheck and onto the margin loan. The dividends from the portfolio cover the interest on the loan. The freed up paycheck money goes back into the portfolio. The portfolio grows faster. The next phase comes sooner. That's the loop. Here's the full stair stack as you see on the screen. Phase 1 started at $6,000 portfolio, and I added my phone bill on the loan, which is around $98 a month. Phase 2, when I've invested $10,000, the internet bill gets added around $105. And when you add those 2 bills up, the 98 plus the 105, that's $203 a month total on the loan. On phase 3, it's the same thing. I add another bill. my energy bill at $155. And when you add those three up, that's $358 of money that will be going towards my portfolio instead of me paying AT&T. Then we have phase 4 at 20,000. We have phase 5 at 30,000, and it keeps climbing. Phase 10 at 145,000 invested. Every single bill I have will be on the loan. That's around $3,371 a month. Nothing coming out of my paycheck. Every dollar of the paycheck goes straight into the portfolio and compounds. These numbers aren't fixed. They're built around my own comfort level at a 12% loan to value target and the bills I actually have. Yours don't have to match mine. Lower your target LTV and your number goes up. Slower, more cushion. Raise it and your numbers go down. Faster, less cushion. Smaller bills mean smaller portfolio target. Bigger bills means bigger numbers. Run your own bills through the math and you'll get your own staircase. Mine just happened to start at $6,000, not $5 million. $145,000 in a portfolio that guarantees enough monthly income to carry the loan, still a long ways away from $6,000. I'm not pretending that's easy or fast, but phase 1 is $6,000. Almost anyone with a brokerage account and a regular paycheck can reach $6,000 if they wanted to. Let me make phase 1 concrete. Here's what's required. A portfolio worth $6,000 and an M1 account with the margin feature enabled. They called M1 Borrow. You need at least $2,000 deposited for M1 to unlock the borrowing feature. That's why I picked $6,000 for phase 1 because I wanted enough bigger cushion before I started to borrow on my margin. Next is you need a portfolio high yield enough that the monthly dividends cover the monthly loan interest. That's the whole list. No credit checks on margin, no applications where a banker decides if you're qualified. Your portfolio is the collateral. M1 looks at what your portfolio is worth, sets a credit line up to 50% of the value, and the money is available whenever you want. So at $6,000 with a portfolio blended yield of 5.23%, I'm generating about $26 a month in dividends. The borrowing rate at M1 right now is 5.65% per year. At phase 1, I keep the loan at 12% of the portfolio. So $720 borrowed against a $6,000 portfolio. 5.65% on $720 is about $41 a year in interest. That's about $3.40 a month. The dividends cover it 7 times over, and the loan is paying my bills. Phase 1 is running. Also note that when you start depositing more funds to invest, the number that you can borrow will go up. Now let's talk about the portfolio I use. My portfolio has 2 jobs. The growth is the collateral and income to cover the loans. I use 2 slices of ETFs for those 2 jobs. In M1, a slice is just your allocation target for each ETF. You set the percentage once, M1 handles buying automatically every time you deposit. No manual trades, no rebalancing decisions, it just runs. That's the reason why I use M1. The moment the money hits my account, it's already working. So let's get into it. The growth slice, which involves SCHG and SCHD. SCHG is a large cap growth ETF, heavily on technology and the biggest U.S. companies. It barely pays any dividends, and that's fine with me. Its job is growth. SGHG goes up in value, the collateral base grows. A bigger collateral means I can carry a bigger loan safely. SCHD is a dividend growth ETF. Right now, it yields about 3.3%, does both things. It appreciates and it pays growing dividends. It's the backbone on the collateral side. Now let's go into the income slice. SPYI, VYMI, and GPIQ. These 3 are what keeps the dividends above the interest cost. SPYI is the NEOS S&P 500 High Income ETF. It sells options on the S&P 500 to generate monthly cash. The current yield right now is around 11.72%. The monthly distributions in May was 51 cents per share. VYMI is the Vanguard International High Dividend Yield ETF. It gives me exposure to dividends paying companies outside the U.S. GPIQ is the Goldman Sachs covered call ETF. The current yield around is 9.74% monthly income. My income slice is what makes phase one work at $6,000. Without high yield income ETFs in the portfolio, the dividends wouldn't cover the interest at a small portfolio size. At $6,000 with only growth stocks, you might generate $100 a year. With the income slice carrying weight, you're generating $300 a year at $6,000. That's what closes the gap between the interest paid and the dividends received. So is this actually safe? It's the question I get the most. Margin sounds dangerous. Let me show you how I make it not dangerous. The rule of 12% LTV. LTV stands for loan to value ratio. I never let the loan exceed 12% of whatever the portfolio is worth. As the account grows, this LTV number will grow with it, but as of right now, while my account is small, I'm going to stick with 12%. At $6,000, that's around $720,000 max. At $10,000, that's about $1,200 max. The loan stays small relative to what's backing it. Here's why 12% matters. N1 Finance triggers a margin call at 40% LTV. A margin call means they can force you to pay back the loan immediately, or they can tell you to sell holdings to cover it. That scenario you're trying to avoid. At 40%, you're in serious trouble. At 12%, you're very far from that. How far? For the loan to go from 12% to 40% of the portfolio value would have to drop dramatically. If I have $6,000 in a portfolio and $720 borrowed, that's 12% LTV. For a margin call at 40% LTV, the portfolio would need to fall all the way down to $1,800. That's a 70% crash from where I started. The '08 financial crisis was about a 57% drop. A 70% crash would be worse than anything in modern stock history. At 12% LTV, a margin call requires a near total collapse of the market. And even then, a crash market doesn't stay crashed. Your portfolio recovers. I check my margin health score on the M1 Borrow every week. It's a gauge, green, yellow, red, showing exactly where I stand. Mine is green. In M1, I can see at real time how much breathing room I have. That's not a hunch, that's a number. So what happens to the freed money? When the phone bill moves off the paycheck, that's $98 that doesn't disappear. I redirect it back into the portfolio as a deposit. $98 extra going into my portfolio. At a 5.23% yield, that's an extra $5 a year in dividends just from that redirect. That sounds tiny, and right now it is. But watch what happens as the phases stack. Phase 1 frees $98 a month. That goes back in. Phase 2 frees up $203 a month. That goes back in. Phase 3 frees up $358 a month. That goes back in. Let's jump to phase 5 at $30,000. I'm redirecting $621 a month in the portfolio. By phase 10 at $145,000, the full $3,371 a month that I used to go to bills is now going to my portfolio every single month on top of whatever I'm already depositing from the paycheck. Now, let me show you this. What I normally do is each paycheck I deposit $250. So let's round it up to $500 a month. So on phase 1, I have $500 a month plus 1 month is $98, phase 1. So 1 month right there is $598 that I invest. Let's add the second bill once I get to phase 2. That's $105 with the money that I normally put in automatically on top of the bills. That's $703 a month that I will be investing once I get to phase 2. And then when I get to phase 3, on top of that $500 a month and on top of the other bills I just added, if I add $155 to that, that's $858 a month that I'm starting to invest. Now the portfolio is starting to accelerate pretty fast. That's how the staircase climbs itself. It's not that I suddenly found around $3,000 a month to invest in. I freed it one bill at a time over years. The strategy funds its own acceleration. So where am I at now? I started phase 1 in March 2026. My current value portfolio is at $10,000 $624.33. My current average monthly dividend income right now is around $34.46. I've earned $148.64 in dividends since I started, and I had my biggest month in June of making $61.99. All right, let's go back to the bill stack and sheet. This is the spreadsheet. The link is in the description. The phone bill has been on the loan since phase one started. Every single month, the dividends cover the interest. Not once has the coverage slipped, not during any market swings. The income slice of my portfolio, SPYI, VYMI, and GPIQ, keep distributing through all of that. Phase two already hit. The internet bill will join the phone bill on the loan this month in July. So $203 a month total now on margin. That's $2,436 a year that stays in my paycheck instead of going to bills. Phase three target is $14,000. I've invested $10,107.80, and I have $3,892 left to go to hit phase three at $14,000. The energy bill will join the loan too. I post my numbers every week: portfolio value, monthly dividends, margin health score, phase target progress. You can watch phase three happen in real time. Now let's talk about the real reason people don't start. It's not that people can't get $6,000. Most people can. It's that they read these articles, decide the strategy isn't for them, and they just wait. Wait until they have more money. Wait until the market settles down. Wait until the strategy makes more sense. Here's what waiting will actually cost you. Every month you don't run phase one is a month your phone bill takes $98 out of your paycheck. Every month phase one is running, that $98 goes into your portfolio instead. Over 3 years, that's $3,528 in your portfolio that would have gone to your phone bill, which will be, for me, AT&T. A 5.23% yield, that's $184 a year in dividends. From one redirect bill over 3 years, the bigger number isn't the dramatic one. The dramatic one is phase 10. But phase 10 only exists because phase one ran. Start small, stay consistent. The staircase does the rest. How do I actually start? How do I actually set it up? If you want to do what I'm doing, here's the setup. Pause the video right now. Get a pen and paper. All right, step one, you open up an M1 Finance account. My referral link is in the description. You can use it if you don't want to, but you need at least $100 to open the account. But you can't borrow until you get $2,000 in your account. Keep that in mind. That's the M1 minimum to unlock margin. Also, there's a step 1.5. Open up a M1 cash account as well. It's like a high yield saving account. Step 2, build the portfolio towards the number that you want. If you want to start using margin at 2,000, you can. Mine is 6,000. I wanted a cushion before I start borrowing. Consistent deposits, automate them if you can. The allocation I use is 35% SCHG, 9% SCHD, 34% SPYI, 8% VYMI, and 14% GPIQ. But you need a blended yield above 5% to make phase one math work at the M1 borrowing rate at 5.65%. Robinhood has lower rates, but you'll have to manually buy your assets and make sure you properly allocate the funds distribution to the stocks. M1 takes care of that for me, so that's the cost I'm willing to pay. Step 3, when your portfolio hits your value, for an example for me, $6,000, go to the Borrow tab in M1, check your availability credit. It's pretty easy. Keep your borrowing very low at 12% of your portfolio or less. Right now, at $6,000, that's $720. Pick your smallest recurring bill, phone, streaming, utility, whatever fits for you, that's under $720 a month. Set that bill to charge to your M1 cash account. You'll get an account number and a routing number with that cash account. Step 4, there's 2 things in step 4. What you'll do is you will go into your loan and transfer the bill amount to your cash account. So when that bill hits your cash account, it'll take that money out. And then after that, redirect the freed money that you were normally going to pay for that bill and send it to your portfolio so you can buy more assets. Now that the bill has been moved to the loan and the money stays in your account for you to invest, now you are all set. Once you figure out everything with your platform and how you want to do it, there's ways to automate it. With M1, there's smart transfers. I have a previous video. All you have to do is look on the account, search smart transfer, and you'll be good. And step 5, check your margin health gauge weekly. Green means you're fine. If it starts moving towards the yellow, slow the borrowing or add more money to your portfolio. That's the whole maintenance routine. To wrap this up, I hope this helped you understand the strategy I'm using to build wealth. Watch it, listen to it multiple times, and if something doesn't make sense, please drop a comment. I do respond to people. It's all about consistency. You start at one bill, a small one, to get your feet wet so you know what to expect and how your brokerage platform displays the numbers. Pick a number to start with. Mine was $6,000. You climb the staircase one phase at a time, and the staircase gets you there. I'm doing this live, every phase, every dividend, every number. Phase 1 and phase 2 are running. Phase 3 is up next. That's my goal. If you want to watch this happen in real time, subscribe. I post every week, and I will see you on the next video.